I'm Keith McCullough, and welcome to day 3 of the Investing Summit. Today is, as we say in certain tournaments, today's moving day, but today for me is learning day. Today is a day where I get to go about as deep as I can with very specific domain experts. So first, I'm going to go here with Mackenzie Davis on commodities, but I'm also going to go with Nancy Davis on the term structure of vol and getting into the yield curve and all the pivots there. So there's some rabbit hole stuff, but there's some real important stuff, and not many people, man, better than you at this subject matter. You've been doing it for a while.
Yeah, we got longevity on our side, if nothing else.
Yeah. It's a crazy. So for those of you that don't know, Mackenzie and I think we met probably 15 years ago when I started Hedgeye.
Right when you started Hedgeye.
Because we didn't know prior. He played football at Brown, full disclosure. That's why he's a lot bigger than me. But when I showed up in San Francisco, I was like, oh, there's a guy who does like macro commodities, and because you're the only person. Yeah. I think there's somebody at Capital Group who's a diversified equity PM who might care about stuff like that. But for you to maybe just start with that, like, I don't think it particularly matters that you were in San Francisco, but I mean, like, why did you pick that, and how did that come to be where you analyst to PM and now managing partner of SailingStone?
Yeah, a circuitous route, not surprisingly. My first job out of school was at Goldman. I was an investment banking analyst, and I was assigned to the Canadian investment banking team.
Really?
In 1993, and so in 1993, Canadian investment banking meant natural resources, and so we were bringing companies in down to the U.S. debt markets, helping them access the debt capital markets, and that was really my introduction to commodities. I did a couple other things along the way, but I ended up at Fidelity, and after about 4 years of building a sort of a prop trading financial engineering business, I decided I really wanted to be on the buy side. So went over to FMR as a high yield analyst, so more sort of credit background, and just spent a lot of time in and around commodities and commoditized businesses. So tech back then, certainly the DRAM space, heavily commoditized, telecom, commoditized, power, energy. And then in 2004, moved out with two friends from Goldman to work with a gentleman named Andy Pallara, who had a really wonderful track record in the value sort of area, including this global natural resource strategy. So went to work with Andy, and it was a strategy he had started in the mid-90s, and that's sort of the genesis of SailingStone, a few iterations down the road. It's
like you either have to be, you're not really old, but you either have to be really old, like 20, 30 years older than us, or you have to have stayed with it. Because there's no real large cattle class of Wall Street analysts that have become PMs in commodities, so to speak. Like the way that, when I was coming up, I guess when it really took off for me was, I'd go to the PDAC that, in Toronto, the Prospectors and Developers Association Conference, maybe.
I think that's right, PDAC.
Hucking darts, you could smoke right there in the conference. Everybody smoked back then, and it was like, you find all this alpha, all these liars, everything in between. And that was a big bull run, right? From 2003 to when gold peaked in 2011, or commodities peaked broadly. And since then, we've had some. It's been devastating, I guess would be some people would say. But again, you guys stayed with it, and now, like, if we're right and you're right, there's a pretty slim population of knowledge, I guess. Would you agree with that?
Yeah, I think that's true in the investment world. I think that's true in the industry as well.
I mean the investment world.
But they're not unrelated,
right?
As we think about these longer cycles. And so you're right. We had a great 10 or 15 year run. We've had a pretty miserable last decade or so. And now we're in a position. I think there's lots of different drivers, but certainly from a supply side, there's not a lot of capital available in the investor world. There's not a lot of experienced developers in the industry, and it's part of what sets up what we think is a pretty attractive sort of longer term opportunity set in and around the resource space.
On like, I think it was you it must have been you that sent me. If you just look at the demography of the analyst class or of the geologists relative to software developers. And what kids are doing when they're coming out of college. I mean, nobody's going into your field, and everybody's going into the other field, right? Everybody can code, but nobody can figure out the cost curve of copper.
Yeah, it's just it's an interesting opportunity set. You have to either be determined or stubborn, or a little bit of both to get through these cycles, because they do, to your point, they're not short. typically. They might be short in individual commodities, but more broadly speaking, those long capital cycles are really what drives our industry.
Yep.
And they take a little while to play out.
Mm-hmm. I mean, so just being there is a competitive advantage. I mean, that's like, I like that, like just because I'm not the brightest bulb on the tree, so I'm like, okay, at least I got some reps here.
Right, you and me both.
And you and I have talked a lot about how the quads, really interact with the commodity cycle or currencies, interest rates, et cetera. And we can get into that. But what I really like about the work, and for those of you that don't, I don't know if you do put out the SailingStone letter to the public, or is that sometimes we put it on the Hedgeye website?
Sometimes it's on the website. I think we have it on LinkedIn or something. Yeah, I'm not particularly adept with social media.
Well, Dan, we should do that. Put that the one that he most recently dug into. But I think it's one thing to have experience, right? And then it's another thing to have like a view and a process. And that's what I love about you. You got both, right? I mean, so maybe we start with like your view on energy transition in particular. Like you can be if you're a politically oriented ESG person, you're going to have a definition of that maybe. If you're a practical person who's trading rates and commodities, you might have a different one. Like how can you kind of lock that down as a foundation so we can then kind of go off that on how you define that?
Sure. Yeah, we've been thinking about electrification, which now is sort of what we call the energy transition. But we've been thinking about electrification for a while, and it really started with a sort of in the natural gas space and in copper. Mm-hmm. We, and I don't think anybody else in the world, is particularly good at forecasting demand. If you go back and look at the history of demand forecasts, all we know is that they're wrong. But you can understand supply. Okay. And so that's really, we don't really think of ourselves as macro analysts the same way you do, which is why I always love our interactions, because we think about the world so differently. But we can certainly understand sort of supply side economics. And so one of the things that we're noticing in gas is that horizontal drilling, fracture stimulation technology unlocked the shale gas sort of asset in North America and was having pretty dramatic impacts, definitely domestically and increasing globally, in terms of this huge low-cost resource that's emerging in a reasonably geopolitically safe sort of part of the world. There are not many assets like that around the world that sit at the bottom of a cost curve that's pretty steep globally. And it's also pretty steep domestically. So that's a really interesting sort of investment opportunity, particularly when you layer in how important gas has been from a decarbonization. We talk about the energy transition and decarbonization, but gas has played a pretty important role in removing carbon, certainly from the power stack. And then copper, of course, any kind of electrification requires copper. Different dynamic there. It wasn't so much that we're unlocking new resources, is that the resources that we have were old and getting older. Yeah. The industry was really struggling to bring in new capacity and continues to bring in new capacity. And so different supply side dynamics, but all certainly investable. And then in and around COVID, electrification became the energy transition. And I have no idea what the correlation is or the causality between COVID and the energy transition is. It might have something to do with free money, but that's
a little bit.
That's just a guess on our part. But as we're having more and more conversations with a lot of our LPs who tend to be endowment, foundation, sort of longer term thinkers, there were a series of policy decisions that a lot of these institutions were making around parts of the real asset world that they're willing to invest in. And so we started to have more and more conversations about energy transition, and we're hearing more people talking about the energy transition, and we realized that there wasn't a common definition to have a conversation around. So when you're talking to an auto manufacturer's energy transition's EVs, right? And if you're talking to a home builder, it's solar panels. But we're like, well, this is crazy. And we sort of invest in and around the natural resource space, but we don't run an energy fund or a base metals fund or a precious metals fund. So we're kind of agnostic. We're just trying to figure out, like, what's everybody talking about and what does it mean? And so for us, first we got to define what the hell we're talking about, right? Like, before we spend $150 trillion, let's just agree what we're spending the money on. So we really think about the energy transition, not surprisingly, first as efforts to decarbonize the world's energy systems. That's what we're really focused on in the West. And if you look at the numbers, population-wise, government-wise, company-wise, people are all in on this idea of net zero by 2050. We can have a different conversation about whether net zero actually what it means and what it doesn't mean. But it's clear that people are committed to this, to decarbonization.
People on the western side.
In the western side of the world. And this is the problem,
Right.
is that the vast majority of the world lives at or below certainly what we consume on a per capita basis. And it's where all the population growth is occurring. So if, whatever the saying is, don't fight the Fed, I would argue you probably don't want to fight demographics either. And so this idea that you're going to decarbonize the world and not acknowledge the increase in demand that's going to come out of the 80% of the population that's actually growing and consuming incrementally more and more energy seemed insane to us. It's like, let's just identify up front, yeah, we want to decarbonize energy systems, but let's also acknowledge we need to grow energy capacity, not shrink it. That's crazy, because those were a lot of the base assumptions that you still see today coming out of the IEA, out of IRENA, these sort of policy setting think tanks. The path to net zero all presupposes that the world uses less energy in 2050 than it uses today. And I would argue there's no way that can happen.
Well, policy think tanks is being very, very nice. Like, that's a nice compliment, I would say. I mean, like I'm sure you've read Alex Epstein's book, Fossil Future. Like these are political animals, these institutions.
Yes.
And it's like anything in politics. I have a desired outcome, net zero, ESG, and everything I do is going to be, trying to find, my way towards that end game without any, as we call it, a Bayesian overlay, like things changing.
Yes.
Like the 10% of people in the world that don't have electricity, like it's like inside of 1 billion people.
Right.
They probably want some.
They would like some. And they kind of don't care.
Like a fridge, maybe?
Right.
Like a refrigerator.
A light bulb, so
Yes.
our kids can study at night instead of studying by a fire.
Actually, I think Epstein makes we're not going to go off on this whole this on a tangent here, but when I read his perspective, I just couldn't believe that the debate didn't involve the benefits of fossil future, like of fossil fuels and what they do for humanity, and it's all about the negative, right? I mean, and all the while, like, he's not sitting there saying there's no CO2's like fake news. I mean, it's just more so, imagine a world where your baby is born, and instead of going to like an American hospital where there's intensive care and there's an incubator, that you don't even have the power to power an incubator. Right? Yeah. And it's like, I started to really think about it a lot differently. Not that I should have feelings about this, but I mean, I think most people would probably be aligned with that.
You would think so, and so part of what we're trying to do is just to illuminate the issue. We don't have an axe to grind.
Right.
We're just saying, here we are today. There seems to be general agreement about at least one component of where we want to get to by 2050 or 2060 or 2070, and we know the reasons why. So what is the best and most capital efficient way and the path with the highest probability of success to get there? And the idea that you're going to do that solely with renewables is just flawed. That may be possible in 30 or 40 or 50 years. Like, we don't know what the technology is going to look like, but CO2 is a problem today. So we need to solve it today, not in 30 years or 40 years, apparently. We need to solve it right now. And so if we're going to spend X number of $1 trillion a year, we should at least acknowledge where we are today, what the path forward looks like, what's realistic, and most importantly, what are the demands of the real world, not your spreadsheet. We can make spreadsheets do whatever we want, but like, we live in a three-dimensional world with lights and cameras and hospitals and people being born. What do those demands actually look like, and how do we solve the problem?
That's to me, it's just common sense, right? So I mean, does it even matter? I mean, yesterday in my discussion with Vivek, which I had I actually knew we were going to talk about it. They got the NTSG ETF, firm, but I didn't quite get that he would totally get the long short side of the game, which is like, he's like, look, if people want man-made problems like ESG, have man-made solutions. And I said, yeah. I mean, so all we've been doing is shorting anything green, anything clean. Like, every single short that's working today, and it's hard to find shorts in global macro when you're in Quad 2, which we can talk about. But I mean, when commodities are now breaking out to the upside, and you see like everything from the hydrogen ETF to PBD, which is the clean this, clean that ETF, these things have been, solar, TAN, for example, these things have been absolute bombs. Like in a raging bull, right? And I wonder if that was kind of his point, people are figuring it out, because you're losing a lot of money on renewables. And that was sold to people as like the big bright future where this stuff's going to triple and triple.
Right. I mean, the perspective we had is that there were decisions that were made at a lot of these large institutions around real assets and what the composition of their real asset portfolio needed to look like. And obviously, after a decade, inflation wasn't that important. If you think back 3, 4, 5 years ago, people were like, yeah, I'm not worried about inflation in my portfolio. Right. So let's take that off the table.
The price of energy is negative, or of oil is negative. Why do I care about it?
Yeah, what do we care about this for? The Fed's going to fix everything forever. Don't worry about it. There's a history of pretty bad returns. As we talked about, the cycle beta was pretty negative for a number of years in the real asset space. And then there were some policy decisions around ESG and commitments around divestment, et cetera.
Do you put a year on that when that became like the thing where everybody kind of went that way to the man-made problem?
Yes, it felt like it started in the late teens.
Late teens.
It really started to gain a lot of momentum. I think it had momentum pre-COVID. It certainly, again, felt like there was a lot more momentum, and I think it was an overlay of historical returns, historical volatility, both in the public and the private markets. Some pressures that these people, institutions were getting from their constituents, and this promise of the future. And so when we were looking at and thinking, because we can invest in renewables as well. We're looking at making.
And you would if you'd found that if it made sense.
If they were good businesses, we would have. And so we looked at them, and it was remarkable. The models, if you didn't know that you were talking about a renewable project as opposed to a shale oil project, the models looked really, really similar. Oh, we've got perpetual productivity gains. We've got very, very small maintenance capital requirements. Again, you can make the math on a spreadsheet do whatever you want. And the same way that we had shale oil companies talking about 100% IRR wells, and then they went bankrupt. And there's no commodity business that generates 100% IRRs. At the corporate level, if you take out a whole bunch of capital to try to make a spreadsheet give you 100%, you can do whatever you want. You can time your cash flow, you can do whatever. But in reality, commodities and commoditized industries typically don't generate 100% project level IRRs. Of course, they didn't, which is why a lot of those companies went bankrupt and why the industry is so hard. The economics are barely above the cost of capital in the best case in shale oil. Same thing was true in renewables. And so we saw a lot of capital coming into a market where the barriers to entry were quite low, and lo and behold, the returns stink.
I mean, that's in the end, Mr. Market's going to find you.
Yes.
And that's what we found. We've also found, and maybe get into that next, like some pretty deep, to your point, deep supply deficits, and like low end of what I think you call the cost curve just won't go down anymore.
Right.
Can you go through those two things, cost curve and supply, and maybe pick an example of what you like? And if you want to do copper, that's fine, because I'm long copper, so I'd love for people to know why we're going to buy more copper. And copper, by the way, if you look at copper, I mean, these things are not owned by anyone, right? Like the physical commodity, which I own, that's my biggest position. I'd always do that instead of the miners. But some of these miners, man, like I look at the holders list, it's like a ghost town.
Yeah, because it's been a decade of misery.
Misery.
Nobody wants to hang out anymore. We haven't been the most popular people at cocktail parties for a while.
Yeah, exactly. Well, I mean, you don't have to do copper, but
Yeah, no, copper's fine. It's relatively straightforward. So, again, commodity prices, and you've talked about this too. Commodity prices, particularly in the short term, get set around expectations, and the size of the financial players in a commodity like copper is 30, 40, 50 times more than daily demand. So it's not, the physical market isn't setting spot prices, it's financial speculators, which is fine. There's just a lot of volatility. Over longer periods of time, and I think it's one of the benefits we have, is just taking longer perspectives, because over short periods of time, the stocks and the commodities are super highly correlated. So if you can forecast short-term moves in commodity prices, God bless you. You're probably not having this conversation. You're somewhere off in your castle. It's really, really hard to do consistently and accurately. But over a longer period of time, prices tend to mean revert around the marginal cost of supply. So to understand what that marginal cost of supply is, you actually have to build a cost curve, which is looking at what price is required for all these different projects to generate a fixed rate of return. And there's consultants, who will do that work for you. The problem is that it's not particularly accurate. And so you really, one of the reasons we've been doing it a long time is because we spent the last 30 years kicking around copper projects, gas fields, nickel, uranium, lithium, we can talk whatever you want, to try to understand these asset level economics. But what's happening and what's
sorry to interrupt, he has engineers on your research team, right? It's not in...
Yeah, it's definitely not me.
It's geologists, engineer, like people that, it's not a spreadsheet. I love how you call it the spreadsheet, guys.
Yeah.
Because you can make up whatever you want in your own mind, but can you just explain that's how you do it?
Yeah, so our research, we try to pair financial people like me with people with a technical background, typically engineers.
Yes.
So we can really understand what's happening at the project level.
Yep.
And we use engineers just because they tend to be more focused on mitigating risk as opposed to extrapolating what they think might be under the ground, which geologists are wonderful, but they tend to be risk-seeking.
Okay. So you much prefer an engineer than a geologist?
At least when we do our due diligence and our underwriting.
Yeah.
We focus a lot more on the engineering side. We love geologists and we want to get exploration, but we expect to get it for free.
Yep. But it's about back to prior to interrupting you. You're like that's how I start to guesstimate my cost curve.
That's right. You're going and you're visiting these assets and understanding not just what's happening today, what's happened in the past, and going to an open pit mine and standing on the edge of a hole in the ground that's a kilometer deep and 4 kilometers long and 1.5 kilometers wide. There's a lot of history in front of you, so you can see what's happened in the past. You can get an idea of the future, and so you can understand on the margin. Are there lots of new low-cost sources of supply that are coming in and flattening the cost curve and driving marginal costs down? That's usually probably bearish as you think about investing in the space. Or is the supply side really struggling? And in the case of copper, if you look back, cash costs have been compounding at about 7 to 8% per year for most of the last 25 years. We had a blip when there was too much capital availability, and so you had a lot of uneconomic projects being brought into the market that temporarily, and I think the same thing is true in gas and oil, that temporarily depressed commodity prices. But the inflation on the cost curve is structural. It's a function of grade, depth, or hardness. And so as we look out at
people,
right, yeah, the skills that we talked about earlier, water. So,
water.
40% of the world's copper supply comes from Peru and Chile. Most of that supply comes from the Andes. Neither of those governments are allowing you to tap those water tables anymore. So now you're building desal plants and pipelines up to 4,500 meter mountains to supply water for the mill and for the mine. All of which just adds to the capital intensity and the operating costs. So you think about copper sort of longer term, there are a number of, forgetting demand, and again, we think the demand outlook for copper is pretty good given everything that's happening with the energy transition. But more importantly, the marginal cost of supply has been rising and we think continues to rise, which is why copper has been one of the better performing commodities over the past 20 years or so.
So then if you overlay demand in any way, I know this is not going to be your favorite thing, but I mean, it's like when the economy is in quad 4, the economy is slowing.
Yes.
I don't think it's subject to debate that we had a global industrial recession that ended last year. You had a Chinese recession that they didn't even state properly, but it doesn't matter. It was a recession in the big stuff that they used to buy a lot of.
Yep.
European recession, et cetera, et cetera. So we had a commodity cycle, kind of bottoming process that's born out of that. So I get excited when you come out of a global quad 3 and 4 recession on the industrial side and start to see places like China. If China turns, that would be like the mother of all turns. There's a lot of reasons demographically, to your point, that may or may not happen. But in rate of change terms, it'd be hard to get any worse.
Yes, and it seems, certainly looking at some of the sort of early data, it looks like it's getting better on the margin.
Yeah, like, I mean, if I could show you, we could crack open my slide deck, which you've seen, but I mean, any global manufacturing PMI number, ISM number, they've been going down for like 22, 26 months in a row. I mean, this was nasty.
Yep.
This was not AI, it was the opposite of AI.
Yeah.
And there's a lot of misallocation of incremental capital at the top-down level associated with that, because everyone's like, I want to put my capital into AI, I don't want to put it into Peru.
Right. Exactly.
Copper mine?
Yep.
You out of your mind?
Yep.
I mean, so demand can definitely, like, it's one thing to say that we can't nail demand like you can supply, or you can't nail demand like you can demographics. But if you get it directionally right,
yes,
it's going to help.
Yep.
And I think that the Federal Reserve's completely missed this, right? Because they don't do global macro, they don't have a model. They haven't even acknowledged that there was a global industrial recession. So it's really tough to be there.
Yeah.
Right. I mean, but for us, selfish capitalists, we're sitting here like, holy hell! I mean, this thing could go. I mean, we've had from the 2020 low, which was a very asymmetric low, negative oil price, to the early 2022 highs in commodities. It's a 2-year rip.
Yep.
But I think what you guys would say is that was a cyclical, or I'd say that was a cyclical rally off a very depressed deflationary level. From here, it could be more like a decade and a half type thing. Is that right?
I think for a number of commodities, as we sit here today and think over the next 10 or 15 years, there's a lot of reasons, both from a supply side and from a demand side, again, without trying to forecast exactly what demand looks like.
You just don't have to have a recession, demand.
Yeah, the backdrop looks pretty good. I think around, and what we really like about your work actually, is we can understand that, we can model that, we can put all that together. Around that sort of longer term trend, which again, I would argue has been in place since probably the early 2000s.
Yeah.
We just had a decade of too much capital and some economic volatility and a pandemic and stuff, around it. I don't know about forecasting pandemics, but there's going to be economic cycles over the next 15 years. And so your process is a really helpful input actually to our process, because you guys model those rate of change dynamics that help understand, maybe the slope looks like this, 7, 8, 9, 10%, with plus 50 and minus 40, on either side of that, as you think about tactically allocating capital. Tactical to us is maybe over a 2-3 year period around that opportunity set. But I think for a number of commodities, and increasingly a number of services around those commodities, there are real constraints. They're highly inflationary. I know people don't like talking about structural inflation, and I don't know about education inflation and healthcare inflation, but we've got a pretty good idea of what's happening on the commodity side. Raw material prices are high and rising, with some volatility, but I think that there's a lot of reasons to argue that the next 10 or 15 years look pretty good from a resource investing perspective.
Well, from you also write a lot about so let's go back down to the cost curve and the commodities that you really like the intensity, the material intensity, I think you call it. I mean, can you explain that and why it matters?
Yeah, I mean, we think about it a lot in terms of this general idea that the energy transition and all these trillions and trillions of dollars that we're going to invest in clean energy should be deflationary. And you've seen it from policymakers, you've seen it from academics, you've seen it again and again and again. And the idea, which I understand, again, sort of Econ 101, if you have a power source with zero variable cost, the more of that zero variable cost you have, of course, it should be deflationary. Yep, we can all agree that makes sense in a spreadsheet. The reality, though, of course, is that those renewable power sources are intermittent. They weren't designed to plug into the grid the way our grid is configured, which means all of those power sources need ancillary services around them. And while renewables might not have very high fixed costs, all those ancillary services have real fixed costs. And if you're not using them consistently, if there's not a lot of load spread over them, those fixed costs are high, not low. Again, it's sort of Econ 101. And which is why, as you look around the world, there is a linear correlation between the rate of renewable penetration rates and retail power prices. So it was true in 2020. We just refreshed the data for 2023. It's true in 2023. And so outside of areas of the world like Latin America and Canada, where you have a massive hydro
infrastructure,
sort of resource and infrastructure, everywhere else it's straight up and down. So renewables may be deflationary in the future. Today they're inflationary, partly because they need all of these ancillary services around them, but also because of the material intensity of building renewables. And so, our last letter that we wrote at the end of the fourth quarter, we talked about this concept of energy return on energy invested.
Yes.
And it's basically like plug a unit of energy into creating a new energy source. What's the return, effectively look like? And the reality today is that hydrocarbon energy return on energy investments are falling, where we've used the best resources. That's true. But renewables have much, much lower energy returns on energy invested. And so if we're going to have a world that's 80% driven by renewables, which I don't think is structurally feasible today, and you're going to have declining demand, you cannot circle that square, because you need more energy to build that energy source.
And that's not taking the view that I have on cost of capital for those renewable projects, or even at the Fernando Valle. I don't know if you've met him yet, or new head of energy. he's like, he uses the example of his house. Like, and this guy's not Mr. ESG, but he's like, look, if the government's going to give me, if people are going to give me free money, I'll take it. Yep. So if the financing rate on these panels on my house is 0, I'll put the panels in the house, I'll take the money. But if the financing rate is 7, 8, 9%, I'm out.
Right.
I don't need these ugly things on my house.
Right.
Right. And so I can't help but think that there's the man-made problem, which is the ESG policy, but also the man-made problem of the perpetual expectation of ZERP or zero cost of capital.
Yeah.
That dog don't hunt when you start to march inflation structurally higher, and what we just saw in the last 48 hours is that Wall Street basically woke up to, holy shit, we're not going to 2%, we're going to 4.
Right.
Like as the base layer.
Yep, and think about that from a marginal cost perspective. And so if you've got renewables that have 3, 4, 5% cap rates,
yes,
and there's a 100 basis point change in your discount rate, that has a huge impact on the marginal cost of supply for energy coming out of those sources. If you have a gas field with a 20% cap rate, 100 basis points doesn't change the economics one way or another. So this huge wall of renewables, I was looking at the data this morning from the Lawrence Berkeley National Lab. The US grid is 1.3, roughly, has 1.3 terawatts of installed capacity. The queue, the interconnect queue, to bring new power projects into the queue, or online, is 2.6 terawatts.
Wow.
So twice the size of the US grid waiting to hook up. They're all not going to get hooked up. 40% of it's solar, 40% of it's storage.
Really?
But it's 90, of that 2.6, 95% is renewables.
This is why I make money on, well, there's that, and then it's macro stupid. Like I say to these solar bulls, it's like, but I got this really good idea, and Elon likes this, and he used to like that, and it's like, no, he doesn't like that anymore. I mean, if you don't get the cost of capital right, you don't get solar right. And people that are solar enthusiasts, or whatever the hell you want to call somebody who's permanently long of something, they don't get that.
Right.
Cost of capital matters.
Cost of capital matters everywhere and always. It has to, certainly as capital allocators, it seems like a pretty important variable to get right.
Now, let's just say that you take interest rates. I mean, first of all, we just had 2 rate hikes in the last 2 weeks. I mean, you take up the 2-year yield by 25 base points at a time. There's 2 hikes. Let's say that the market hikes a couple more times. I mean, would that be, so if you look at the existing investments that you have, would a rising cost of capital for them be positive or negative?
I think it would be positive for us on the margin, mostly as a function of capital flows.
Yes.
I mean, I think one of the things that we've seen is there's just so much money investing in the same themes. I don't know if they're chasing them or not.
Yep.
But there's definitely a herd mentality that's occurred, and we are definitely not part of that herd. And so,
like the flows, like if interest rates do the opposite, you not only would you buy something boring like treasury bonds, but you would buy something that again likes falling interest rates, tech, growth, et cetera. So you've been
long duration, long convexity asset.
Yeah. You're on you've been in the desert of starvation for flows. Like there's been no flow.
No, it's been pretty quiet for a while. So I think it would it would certainly help in terms of capital availability, and I think rebalancing some of the flows into the space. I think it'd be good for our investments. And I think it would present a more realistic framework to think about incremental capital allocation, not just at the portfolio level, but from a policy perspective. Where are we spending money and why?
And also just I think a very obvious thing, if I take the cost of capital from 0 to 4 to 8, and it's going to be higher than that at the project level. If I take it up there, then the existing projects that are already funded at the much lower level are much more attractive. Right? You can't bring that online at that cost of capital.
Yeah, as long as you've locked in your cost of capital.
Right. Now how if you look at your portfolio of what how many do you think are locked in? I don't know if there's a number.
Yeah, I think it's a hard number to quantify. I guess so you're talking about in some respects the cost curve for capital starting to shift.
Exactly. Permanently.
Permanently. And so being at the bottom of that cost curve, when the cost curve starts to shift, I think it's just another way of saying the same thing you just said. I guess we think about it in the same way we think about everything in terms of cost curves. The same way, from a supply perspective, like if you own low cost, long duration, truly like long duration assets that sit at the bottom of the cost curve, in a world where rates are going up, capital intensity is going up, operating costs are going up, power costs are going up, permitting is getting harder, not easier. There's massive scarcity value in those assets that isn't being priced today. So to your point, right? You look at some of the holders of some of these companies, you're like, well, nobody's there. That's right. The stocks are trading at discounts to intrinsic value. There should be premiums ascribed, we believe, to a lot of these assets because they're unreplicatable. You can't make a new one.
Exactly.
There is no other new, long, 30-year-old, 40-year-old copper mine that sits at the bottom of the curve.
And it takes, like I used to model these things. I mean, you have to. It takes, depending on what you're talking about. I mean, if it's high grade nickel or something, you got to, what is it, 7 years to produce, from discovery to production, maybe?
15 now.
15?
For bulk mining, yeah.
Like, I mean,
lithium short.
So you got
really short
all
cycle.
these dynamics that make it so, like, it's so tasty to people that have made money, like, on big commodity cycles, like when you think about it that way. And then there's, of course, which you've also written a lot about, I mean, there's the safety of the supply. Right. There's this new geopolitical world, like this, this place we used to call Mesopotamia, that's kind of like a little pissed off, and these people, and it's just, like if I have to take, which I have a view on this. I mean, if you don't, you either believe the rate of change of geopolitical risk is going up or down.
Right.
And it's not like let's use uranium. I'm long uranium.
Yep.
You good on uranium? Talk about uranium?
Absolutely.
Well, nobody else is. I mean, so I'm not. I don't know.
A couple of you guys.
I've
seen a couple of your guys who are pretty good at it. So.
Well, there are a couple, and you're one of them. All right. So who's going to say absolutely on uranium? But I mean, like, just talk about that. I mean, to get uranium, where do you have to go?
Right. Well, today, I mean, Kazakhstan sits at the bottom of the curve, and then we're in Canada, and then you start moving into sort of different jurisdictions.
Kazakhstan, Afghanistan, you got to go to the stands, and it's not.
Or you're going into Africa for a lot of the supply, so uranium is really, really interesting. I think it was completely off everybody's radar 2 years ago. I think it's on more people's radar, today, and the price, reflects that. But I would say that's all we've seen is mean reversion, and now we have the structural supply-demand dynamics that are starting to play out. And it's not enough to say, oh, uranium's at 80 or 90 or 100. And so now that's a supply signal. So we've hit incentive prices for greenfield supply to come online. Okay, yeah, go ahead. So what's the asset? What are your permits? Can you get water? What do you do with the tails? All right.
What's the tails?
The tails are sort of after you get done mining the ore, maybe it's 3, 4, 5%. Ore, right, is 3, 4, 5% uranium if you're hitting a massive home run. What do you do with the other 94 to 99.8% of this stuff that's radioactive?
Well, I know what they did with it, like where I'm from in Canada, just north of there. I mean, where Red Lake, Ontario, all the gold mining activity. It's nasty where you put the tails. I forgot that was called tails.
But I mean, unless you have an open pit that's permitted to dispose of those tails, you're disposing of them underground.
Yep.
And most of the uranium mines are underground. So you're going to build a pit underground for your tails after you get, you're going to build 2 underground mines? The capital intensity is high. Then you have to mill the stuff. So you got to process it. And then there's all of the downstream processing that's been dominated, to your point around geopolitical safety, right? It's all been dominated by the Russians. Well, they're maybe less likely to engage in a friendly trade with the West today. So what does that look like? So there's all these, to my earlier point, so many interesting investment opportunities, not just upstream, but in some of these services as well. It was easy when the world was completely connected and globalism was the rage, and it didn't really matter where you process the stuff. You could get it kind of whenever you want. We've had these really interesting conversations, not just in the uranium space, in nickel and copper, as well with executives at companies saying, look, we've been going to Washington for a decade, and we've been trying to get in front of the auto OEMs, for 5, 6, 7, 8 years, trying to explain, like, you guys you're all in. Maybe they're a little less all in today, but you're all in on EVs. Like, they require raw materials. They require
electricity.
To the material intensity you talked about earlier. They require a lot more raw materials than what you're used to building. Like, where's it coming from? Like, oh yeah, no, we don't worry about that. Like, Okay.
Oh,
But
great.
like what we're going to get it on the LME. Okay. But like in nickel, for example, if you look at where all of the nickel supply is coming from, it's coming from Indonesia.
Very hard to find high-grade nickel.
It's impossible to find particularly high-grade sulfides. So these in Indonesia, it's a nickel laterite. It's all backed by the Chinese. The Chinese control all of the flow. And so yes, they control now the nickel market, and nickel prices have fallen because there's a wall of new supply that's come on in a relatively short period of time. It's an environmental disaster. It's a disaster. If you look at satellite images, if anybody cares about the environment, you're not buying anything with any nickel that comes out of Indonesia. I promise you that. They're dumping the tails that we just talked about into the ocean.
Oh, great.
It's okay. Don't worry about it though, it's fine.
Wow.
But like where are you going to get the nickel for your batteries for your car? And so there's back and forth and finally, like, you don't understand, like, do you have your foot on the throat of a nickel mine? Do you control the mine? Because it's resource scarcity, it's not processing. Right? Processing, we can build new plants. And the IRA is helping us build new plants. We're reshoring manufacturing, that's wonderful. But like, where is this stuff? It's not always where you want it to be.
I don't think unless somebody's actually done it. And I did it like again a while ago.
Yeah.
But I think in somewhere between around 2005, some 2006, I went to what was supposed to be a high-grade nickel discovery in northern Quebec.
Yep.
Right? This is way up there, right? I'm Canadian, I'm pretty well versed in how cold it can be at that latitude. And you get there, you got to watch where you walk on that they have the boards out,
Yeah.
you have some guys smoking a dart on a rig, and they're just like, and then you're like, holy shit.
Yeah.
This is what we're looking like. This is going to take a while.
Yeah. It's hard.
And they didn't. They ultimately, like that place in particular, it was a borderline fraud, like a lot of Canadian kind of like warrant type activity can be. But I just like, I guess the last people to understand that practical experience would be somebody in Washington.
In all likelihood. Yeah. It's hard to understand just how difficult it is to produce this stuff. And the easy example, if you think about a gold, which we haven't really talked a whole lot about, which is fine, but just you got a gram. Like if you have a gram a ton, it's a pretty good gold mine. So that's in the ore body. That's like plucking a millimeter out of a kilometer. That's in the ore.
Yeah.
Yeah. So then you've got like all the overburden and everything else, and think about how much rock you have to move and how hard it is to process and extract that little thing that you're trying to get out of the ground. And so you go to these big open pit mines, they're running 400-ton trucks. People are like, well, what's a 400-ton truck? Well, a 400-ton truck, if I stood next to the wheel, the front wheel, my head, like the bottom of the wheel well comes up to here. I mean, like 400 tons is a lot of earth to move. And they've got 20 or 30 of them driving around in circles 24/7, 365.
Just getting rid of all the other stuff that isn't that millimeter.
Yeah, just to get the copper for your iPhone or whatever.
It's
whatever
incredible.
It is.
Like it's incredible perspective. I'd encourage a lot of people to try to go see one. Just because we're running out of time. Do you guys? You said do you own the nickel mine? Do you guys? Where are you at on nickel? Do you have a company that a big investment there? They're pretty illiquid.
They're pretty illiquid. It's been hard to find. It's hard to find a really high quality nickel mine that sits at the bottom of the curve. And the problem today is that the top, the cost curve is now capped by all of this HPAL, this high pressure acid leach volume that's coming out of the nickel laterite mines in Indonesia. So the nickel market has been flooded with supply. It's been a horrible place to invest for the past year, not dissimilar to lithium. So again, it's easy to get really excited about the next 10 or 15 years, but for sure you have to pick your spots.
Yeah,
it's not all roses.
I mean, you probably know that's how I roll. So once I get like Druckenmiller, it's one of the best things I've ever heard. Like when you find something, like spread your wings. Yeah. Like when you get into a commodity cycle, I own all the big stuff. I mean, we own oil, gasoline, copper, everything. Bitcoin, I call that a commodity too. I mean, uranium. So then the next phase is I start to look at all the things that haven't broken out yet.
Right.
And man, every day of my life at 4:30 to 5 in the morning, you can see anything that is an industrial metal or some component of what China used to buy the shit out of is just making a little bit more of a move higher. Right? And so you could just like there are so many different places I guess that's got to be pretty exciting for you.
It's really interesting. There's a lot of different places to make money.
Yeah.
There's probably a few places to lose money along
Yeah,
the
well,
way.
there's a lot of fraud.
Yeah, there's a lot of fraud, and again, there's a lot of narratives, and so it's really important to try to figure out a process to separate the narratives from the economics, because it's the economics that are going to drive outcomes over sort of the timeframes that we care about.
Yeah, really well done. Thanks for. Well, I think your investors should thank you for staying, for gutting it out, man.
Yeah.
Because it's like, again, there aren't many people with the experience and process that you have. So I wanted to make sure that everybody got to know you. So thanks.
Well, hey, thanks for the opportunity. It's great to catch up as always.
Yeah, it is.
Awesome.
He's Mackenzie Davis. How good is he? I go Mackenzie Davis to Nancy Davis. I just kind of realized that.